take news and let me abuse. Jared Lane take Jared Lane take. What's going on, y'all? Give you what you need to take news and let me abuse. What's going on, y'all? Jared Lane take.
Hey, how y'all doing? What's going on, y'all? This is another episode of Land Y'all Blenders Podcast. I am your host, Jared. Make sure you subscribe and follow. Welcome to the show. We have a new guest, new season kicking it off. This time we're going to talk about financial literacy with Miss Anitra Blue Francis. Welcome to the show, ma'am.
Thank you, Jared. Thanks for having me.
No problem. Thanks for being on. All right, so let's get right into it. I know you're a busy lady. And you have a lot of stuff going on, so let's get right into it. So give a little bit of background about yourself.
Sure. Born and raised here outside of the greater New Orleans area. I grew up in St. Rose and Destrehan, Louisiana. I studied finance at Louisiana State University in Baton Rouge, Louisiana. And I am a financial advisor. I started a financial planning practice almost 14 years ago in Baton Rouge, Louisiana. And since then, I've grown a national financial planning practice where I work with people like you to impact the lives of the people you love the most.
All right, you letting the cat out of the bag. You let them know you are me and my wife's financial advisor.
Oh well, look, I didn't even go into that deep, but
okay,
that wasn't my intent.
Right. So tell the people what made you want to get into the financial arena. That's not usually I guess one of the sexy disciplines in college. Usually people go to IT, engineering, business. Why finances?
Yeah, well, good question. Those of you who have known me since I was a child, you probably remember my childhood dream career was to become a corporate attorney. And I was on my way to law school. I actually entered into college with the expectation of me going to law school, which is why I wanted to be a part of the College of Business. And I just narrowed that discipline down to finance as it was something that interests me. But after doing an internship within the industry for about a year between my junior year and senior year in college, I changed my mind, and I haven't looked back.
All right, that's very interesting. I could see you being a lawyer. I can really see that. I can really see that.
Look, and so many people say that to me, Jared. Even when I run into people that I haven't seen in a long time, they assume that I am an attorney, and I'm like, no, I know that's what I said I wanted to be when I was a kid. But life has its way of dealing a set of cards that I could not refuse.
All right, that's what's up. So you know you want to get into finances.
Mm-hmm.
So where did you begin at? Like somebody we'll talk about that. Where did you begin?
Sure. So like I mentioned, I knew that I guess I was always a planner at heart. I knew that it was important to have a plan B if plan A didn't work out. And so I wanted my plan B to be something that I knew that I could excel in, something that I would enjoy, and obviously something that would support the lifestyle that I wanted. So I wanted to focus on earning a degree that would be beneficial to me, whether or not I went to law school or not. It wasn't until my senior year in college, actually after college graduation, I was still working full-time as a financial representative, but something in my spirit just kept telling me to don't change my trajectory at this point. To be totally transparent, I did not want to go into student loan debt. I escaped undergrad without any student loans, and I did not have offers of scholarships being thrown at my feet for law school, and I didn't want to make a $150,000 commitment. And that's honestly why I chose to stay in this career. And so now I have an opportunity to work with people around the country, helping them to manage their finances while paying down student loan debt.
I hear that. Student loan debt is a bitch.
It is.
Yeah. So, all right. So you starting this career. Um, what is your biggest? How do you present to your clients, especially clients you've never met before? You pitch into them. Why should someone pick you as their financial advisor?
Absolutely. Well, I think my approach is what captures a lot of individuals because I learned a long time ago that this industry that I work in financial planning is not only a very logical business, but it's very emotional. And what I mean by emotional is we're talking about your money. We're talking about your relationship with money. We are reminiscing about your earliest childhood memory of money and or investing. What is it that you witnessed growing up? Because quite honestly, that does have an impact on us as adults in our spending habits or our saving habits or the lack thereof. And I like to take the approach of meeting people where they are and educating them. I've learned that most people don't know what they don't know until they've had an opportunity to be educated. And there's so much information out here on Google or other podcasts, other forms of communication that I know that it can often cripple or stifle some individuals from making decisions because there's so much out there. So I like to meet people where they are, identify what their goals and objectives are, gain an understanding and perspective of a perspective of what is their relationship with money, and then ultimately designing a financial plan catered around their cash flow.
All right. So I'm not gonna lie to you, but I don't even remember how I don't remember how we met. I don't even know how
We
did we meet?
we actually met, which is how I meet 9 times out of 10 of the my new clients. We met through a mutual friend.
Right. Okay. Yeah. Okay. Now I remember. Okay.
Do you remember?
So yeah, I
Mhm.
remember. So when we first met, me and my wife was very hesitant. It was like, what is a financial like? To be honest, we didn't even know what a financial advisor was. Like we thought you was just somebody who was just trying to sell life insurance just to get our money, and we ain't getting a huge benefit. But I remember when we sat down to you explained it, broke it down to us. We didn't know the huge benefits of life insurance and how you can use it, how you can leverage it, how you can pass it on. So, can you speak a little bit about how life insurance works and why people should purchase it and how they can use it to leverage other things in the future?
Of course. Well, I think before I share that, I think it's important to note that my philosophy around financial planning is heavily focused on creating a very strong financial foundation. I think it's very attractive to most people to talk about the fun, sexy, exciting investments, the market, the stock market, growing your money, what's your internal rate of return, how much was your return last year versus the next person. But I really believe that approaching financial planning from that foundation is important to build upon because despite whatever savings or investment strategy you may implement, if and when life comes at us fast, then that entire investment plan or portfolio could easily be dwindled if we haven't done the proper foundational planning. I believe that proper foundational planning consists of accumulating and maintaining at least a 3 to 6 month uh, monthly emergency fund. I believe it's important to have adequate amount of life insurance so that if and when a premature death occurs, the financial plan doesn't have to be derailed. In addition to that, I believe it's important to have your earned income protected from loss. In many situations where I'm meeting with professionals, especially those that are still in the accumulation phase of their financial portfolio, many times those individuals have a lot of debt, whether that's student loans or consumer debt or mortgages or other personal debt. And in the event that either one of us died prematurely, it would be best not to leave that financial burden to your loved ones. And so the easiest solution to that is to implement the proper amount of life insurance, despite the type or anything like that, but just making sure that you have the right amount of coverage. So having that strong foundation that includes that emergency fund, your earned income protected from loss due to an illness, injury, disability, sickness, as well as making sure that you have adequate amount of life insurance in place to make sure that the things that are important to you that you are planning to get done if you still are living, making sure that those things can still get done even in the event of a premature death.
Okay. Cool. All right. So can you talk about how why some people, especially our people, are hesitant to speak with someone about their finances? Because me and wife, we were the same way. We didn't really want to tell you everything we had. We didn't know who you were. Why is it in our community there is such a disconnect from financial literacy?
Well, I think it goes all the way back to the beginning of time, right? And that's a whole nother topic for another day. But stemming from that, because of the history of our community, it's often a taboo to talk about money and finances and income and debt and interest rates and the market. But I think the more that people are open with this information, with those that they trust, of course, I think it would minimize a lot of the myths that are out there. Because from my perspective, I have an opportunity to meet with so many different people from various walks of life. And the reality is, many of them are all making assumptions that no one has actually had conversation or dialogue around. And if they have, most likely they haven't had it with a professional, with someone that actually is abreast to the industry, the changes, the products, the services, the various services that are out there. But I think having a mindset where I'm open to having this conversation with those that I care about and those that I respect, which is another reason why I appreciated how we were introduced, because you're absolutely right. Me picking up the phone to reach out to you or anyone else out of the strength of, hey, I'm Anitra, that's not going to go very far. But
Right.
because we had that mutual connection, on the strength of that relationship you had with that other individual, you were willing to at least have the dialogue, the initial dialogue. And then over time, I realized that I am in a position to earn your trust over years. And it's been almost 10 years that we've been working together. And
Yeah,
so
almost. Yeah. Yeah.
I'm sure that your level of trust for me has increased over those years. But I think meeting people where they are, educating them on what is it that they don't know, and then providing them with enough information to empower them with enough information so that they can feel empowered to make those financial decisions. I'm here to be your accountability partner, one that I know what your goals are. I know what we're trying to accomplish. I know what the end goal is. So keeping the end in mind, how do we get there? And then really just holding my clients accountable to achieving those goals.
Right. And you do you do that. Like you just be you waiting with the sheet and you be like, I thought we had this, and this. You're right. Anyway, can you please tell the people what type of services that you provide and you offer?
Sure. So I work in three different areas of planning. The first area is personal financial planning, where I'm working with families and individuals to help them identify what their personal, professional, and financial goals are, and aligning the things that they want to reality based off of their cash flow, and helping them come up with a strategy around that. Specifically, that often it has dialogue around their emergency fund. How do we save for retirement and save for my child's education simultaneously while trying to pay down debt? Like, that's the biggest concern that a lot of families have today. It's important to save, Anitra. I get it. I want to, but how do I do that and pay down the debt and save for the personal savings goal that you're trying to accomplish at the end of the year, as well as the long-term goal? So that's the first area of planning that I work in. In the second area, I spend a lot of time with established business owners. Many of them have full-time employees that range from 2 employees to over 200 employees. They work in various industries around the country, and we help them to identify, design, implement, and service their group benefits, to attract and retain those employees. So we work with the owners of the company along with key executives of that corporation, and we help them design an employee benefits package that many of you are probably participating in, whether that's your employer's group medical plan, their group life insurance benefit, their group short-term and long-term disability benefits, a retirement package, and helping them explore what their options are there. In addition to with those business owners, we're helping them to plan for their succession plan. How do we transition that owner out of that business when they're ready to retire? So we work in that space pretty heavily. And then the last space or the last area rather of financial planning that I spend a lot of time in is in investment management. And there we're working with individuals that have accumulated a nest egg already. Oftentimes these individuals are age 55 and older, and we're helping them to transition and prepare for their next chapter in their lives, which is often the chapter that you and I are pursuing now, which is now they're ready to start spending their dollars. So we're not focusing more so on the accumulation of assets to create income, but now we're focusing on, now they've accumulated this nest egg, how do we come up with a retirement income distribution strategy? How do we manage their taxes? How do we manage the Social Security benefits? What is this Medicare benefits that I need to be aware of? How do I maximize my pension if you're lucky to have a pension from an employer, etc. So those are the different areas that I work in. Oh, Jared, I can't hear you.
Thank you. So first question, let's go to the investing side, because when we first came to you, I had an issue with buying life insurance and investing into a 401k plan and all that. Like I really didn't think it was necessary. I thought, how we was always taught to save. Save your money, never know when something's going to happen. Save, not learning anything about investing. So how do you get to your clients and explain it? Because you explained it to us well, but I want you, how do you explain to your clients about getting past the saving mentality and start investing your dollars and have your dollars work for you?
Absolutely. And I like that question because it kind of goes back to one of your earlier questions, like, why is it such a taboo in our community? Like, why don't we talk about this more in our community or even within our own households with family and friends? And one of the things that I realized, I guess maybe about 5 or 8 years ago, that a lot of the people that I'm working with are they're the first in their families that have enough income coming in to actually plan for long-term planning. Whereas I think back to my parents or even my grandparents, they did not have enough income coming in to even think about 5 years from now, or don't even try to ask me about 10 years from now about retirement, because I'm
Right.
just trying to make it to the end of the week, or I'm just trying to make it to the end of the summer. So I recognize that, and that's some of the things that I learned from my clients when I'm first interacting with them. I'm asking them, "Hey, what's your earliest childhood memory of money? What have you learned about money and investing from your childhood, from your parents?" And if they are parents themselves, I like to have a follow-up question to that is, when I have an opportunity to sit down with your children in 20 years, what is it that you want them to have learned from you about money and investing? So that's the first thing. I recognize that a lot of the topics, ideas, tools, strategies that I am bringing to the table, it's often the first time that we're hearing about it outside of, yes, you save in your 401k, yes, you save money at the bank, and then that's it. Maybe you may have a CD, because that was really popular back in the days in the 80s when we were babies and kids, because interest rates were so high at that time. So everybody was running to the bank to save their money at the bank because interest rates were so high. Fast forward to today, that's not the same. So, or fast forward to a couple that I may be meeting with today, if they're at an income level that's 2, 3, 4, 5 times greater than what they were used to growing up, then those concepts are not the same. Those same saving strategies are not going to be the same for someone that has different financial capacity than others. So that's one thing that I like to highlight in those conversations with clients when I'm meeting with them. But as it relates to the topic of investing, I think it's important to identify different buckets that you have for your dollars. For example, I think a lot of us here tonight can identify with, you have your home run dollars, and those are the dollars that you and I need to reinvest in ourselves. Maybe it's to expand the business. Maybe it's to offer and expand more employee benefits to your employees at work, or maybe it's for you to start a business. Those are dollars that we're not talking about, right? Because you need those dollars to reinvest in yourself. And then you have your aggressive dollars. And those are the dollars that you and I are intentionally making a conscious decision to put in the market, whether we're putting it in the market for long-term investing, like 10 plus years from now, or maybe we're putting it in the market.
You gotta specify what you say when you say market.
Okay, the stock market. Yeah. Sorry. I'm sorry. So yes, if we're putting those aggressive dollars, you're intentionally putting dollars in the stock market. You're intentionally saying, I want to invest these dollars. How you invest them is your prerogative, whether you're investing in individual stocks or bonds or ETFs or mutual funds, etc. But you're intentionally making that decision to invest those dollars. And how you invest is going to be based off of your risk tolerance. Your risk tolerance. And your risk tolerance could be very aggressive or very conservative or somewhere in between. And there's no right or wrong way to be titled. It's really, most of the time, that what's driving that risk tolerance is your time horizon. So typically, if you have a longer time horizon before you need the money, most likely that individual is probably going to be willing to take a lot more risk, because I don't need the money today, or I don't need it next year, or I don't even need it for the next 5 years. So for that, because my time horizon is long, 10 plus years, I'm willing to potentially be more aggressive. Versus if someone has a shorter time horizon, meaning, hey, Anitra, I'm planning on buying a house in the next year. Well, obviously, we're not going to want to gamble or take any risk with those dollars by investing it in the stock market. So maybe we're putting that in a more conservative bucket. Maybe that's a savings account. Maybe it's a money market account, something that's very liquid where you can easily get your hands on that money within a 24-hour period without having to jump over hurdles. Or maybe we're looking at something that's a little bit more long term. So you have those aggressive dollars going there. And then you have your safer dollars. Those are the dollars that most people are intentionally putting aside. They're intentionally not putting it in the stock market. Maybe there's a stash at home. Maybe it's money that they have in a savings account. Maybe it's money that they have in a money market account or a certificate of deposit, something that's very, very safe. And so once you've identified, okay, these are the dollars that I'm willing to take risk with, these are the dollars that are going to be my safe bucket, then we can design a strategy around that. But ultimately, when it comes to investing, you want to make sure that you have a diversified portfolio. There are 9 asset classes within that is considered or for an account to be considered diversified. And those 9 asset classes are large cap, mid cap, small cap, international developing markets, international emerging markets, real estate, commodities, and cash, and fixed income. That's the last one. And so in order to have a diversified portfolio, you want to have a little bit of your dollars spread among all of those different asset classes because we know.
I got a question. Can you explain? I know the difference, but can you explain the difference between what's a large market cap, mid cap, and small cap?
Mm-hmm. So your large cap assets or asset classes, rather, those are considered to be your S&P 500 index. They're designed to identify performance of the broad domestic economy. So an example of a large cap company may be a Walmart or maybe a Home Depot versus, a small cap company may be, what's an example of a small cap company right now?
Would it be like Dollar General, maybe? Maybe Dollar General?
Yeah, that's a great example. And so that's the difference between those. And so we don't know which of those asset classes are going to outperform. So not only is it important to have asset diversification, but you want to have asset allocation. And here's the difference between the two. Asset diversification is the concept that we all heard from our parents and grandparents. Don't put all your eggs in one basket.
Yes.
That's the concept of diversification. The concept of allocation is having multiple baskets. I not only want to not just diversify among and not put all of my assets in one basket, but I want to have multiple baskets. Those multiple baskets represent those different 9 asset classes. We want to have a representation of our dollars in all of those so that we could minimize our risk, ultimately increasing your return.
Okay. All right. Oh, well, we have a question here. Hold on, let me pull it up. What's going on, Byron Francis? Thanks for watching the show. When should we start planning for our kids' college tuition?
Oh, very good question. Kids' college tuition. So the earliest that you can start is as soon as the child is born and that you have a social security number. So that's as early as you can start. I guess the earliest that I have started with clients in the past was when a child was 2 weeks old. Of course, you can start planning in other areas before you have children, but specific savings accounts that are specifically geared to education funding, like a 529 plan or an UTMA account, then those accounts you need to have the social security number of that child. So obviously, because of the time value of money, the sooner you start, the better you are. The later you start, most likely it's going to require a lot more money to reach that, and you're probably going to take a lot more risk than what you actually wanted to in pursuit of that return in that short period of time. So I would say as soon as you know that you're having a baby, start planning.
All right. You talked about it earlier. Can you talk about what a CD is, a certificate of deposit? Because I remember that when I was younger, my mom used to always talk about that. I remember seeing that on bank statements and
Yeah,
bank brochures a lot, but you don't see it a lot anymore. You want to talk about what a certificate of deposit is?
Sure. A certificate of deposit is a security that it's heavily impacted by interest rates. So if interest rates are up, most likely that certificate is going to have a high return, and vice versa if the interest rates are low. Most of the time, the way certificate deposits work is you take your money, you buy a CD, a certificate of deposit, at your financial institution. They give you a certificate. It's literally a piece of paper, and it has a maturity date on it. Maybe it's in 18 months, maybe it's in 18 years, maybe it's in 5 years, but there's a maturity date. And when that certificate matures, when it reaches that date, well, you can go in and turn in that certificate and get the cash. Hopefully, you're getting the cash back plus an interest.
Okay. So is a CD similar to a bond?
Good question.
Okay.
So a bond, savings bonds are similar to certificates of deposits because they are not sensitive to market volatility, meaning they're considered a more safe investment because they don't ride the roller coaster like your equities would if you were invested in the stock market. And savings bonds, a simple example, let's say if the city of New Orleans or the state of Louisiana, they needed to uh, do more infrastructure. And the state of Louisiana just says, okay, we need $20 million or whatever the amount is. We need this money to build this infrastructure. Maybe it's a new road or expanding the interstate or something. Well, they would issue out an opportunity for people to buy a savings bond where the state of Louisiana would issue you a bond. Again, a bond is just a sheet of paper that has a maturity date on it. Most of the bonds, the maturity dates are much longer than they are for a certificate of deposit. Most certificates of deposits, those maturity dates may be in a very short period of time. Sometimes they can be 5 years, but you really don't see a maturity date for a certificate of deposit beyond 5 years. Whereas a savings bond, the earliest that you may be able to, that maturity date may be maybe 5 years out. They can be 10 years out or even 30 years out. And of course, it has an interest rate on it. So let's say the state of Louisiana says, all right, we're issuing out bonds. Jared decides to buy a bond, and that bond matures in 30 years. Well, if Jared gave the state 10 grand to buy that bond, in 10 years, or in 30 years when it matures, he's going to go and get that money. He's going to get his $10,000 back plus interest.
Okay.
And that's how a bond works, a savings bond or a municipal bond.
Okay. That was a good explanation because I always wanted to know what was different. Because I always, when I watch the stock shows, they were talking about the bonds are going up today or whatever it was.
Mm-hmm.
So the issuing bonds. All right, cool. All right. So let's talk about life insurance because recently, I think it was maybe last month, you were telling me how you could leverage life insurance policies on loans and stuff like that. But can you talk about just the multiple differences of life insurance and how you can leverage it and how you can pass that on?
Sure.
Right.
So most of us are probably very familiar with the most common type of death benefit. There are multiple different types of insurance out there, but for the most part, to narrow it down for simplicity, you either have term insurance where you have a death benefit in place for a period of time. Maybe it's for 10 years, 20 years, 30 years, or maybe you only have the benefit if you are employed with your current employer. So however long you're employed there, that's how long that benefit is. Once the term is up, the contract terminates. In that example, if you're still alive, obviously the insurance company, they're not paying a death claim to your family. In most situations, or in most companies in the industry, they keep those premium dollars in that example. So in that example, the insurance company, they won the gamble. I purchased life insurance. I didn't die in 20 years. That's a good thing. But it's even a better thing for the insurance company because they got all of those premiums for those 20 years. They were able to take that money, invest it, and do whatever they wanted to do with it. And then now you don't have any coverage. So that's term life insurance. I think term life insurance is a great solution because a lot of our needs for life insurance are temporary. If you think about it, most of us need life insurance really just during the years where we're trying to build our investment portfolio, trying to pay down debt, trying to pay the mortgage off, trying to pay the kids' tuition, get them to college, pay the tuition in college, and get them off to a good start. So let's say for about 30 years, term insurance is probably appropriate. Permanent insurance is just the opposite. You have coverage permanently for the rest of your life. Whether I die at 36 or whether I die at 106, a death benefit is paid. Unlike term insurance, a death benefit is only paid if I die within the term. Another way to compare the two options is to think of renting a house versus buying a house. Neither one of them is the right or wrong answer. It just depends on what your needs are at the time. Term insurance or renting the house makes sense for a lot of individuals. Buying the house also makes sense for a lot of individuals because eventually, even though I'm paying more to buy this house with maintenance, insurance, taxes, etc., eventually I'm not going to be paying that mortgage anymore. Maybe I'm going to pay the mortgage off in 15 years. Maybe I'm going to pay it off in 20 or 30 years. But in 30 years at the most, this house is going to be paid for. Well, equity accumulates in that house over time, as we all are aware of. Well, with permanent life insurance, it works just the same. It's more expensive than term. It's certainly not for everybody. However, if positioned appropriately, that equity that accumulates, or what we call accumulated value, that accumulated value grows over the life of that life insurance contract. And at some point in the future, not in a short term, it's not a great strategy for short-term savings. So 10, 20, 30, 40 years later, that equity can be accessible to you, even while I'm still alive or even while you're still alive. And that equity is what Jared is referring to. That equity is something that I can touch, and I can touch it in multiple different ways, just like you can touch the equity in your house without having to sell or get off of the asset, right? Sell the property. And so there are ways that I can leverage the equity in my permanent life insurance because it is considered an asset. Unlike term insurance, it's not an asset. It's just pure, we're just renting coverage for a period of time versus we are owning the coverage with permanent life insurance. And if positioned properly, that tool could really be a great financial tool that one can use in the future. Again, not designed to be used in a short-term time frame, but definitely 10 plus years later, it's certainly an asset that will continue to build equity despite market volatility.
Okay. Is it I can is the which one is any one of them cheaper than the other rate?
Yep. So the
Yeah, which
term
one's cheaper?
insurance, the term insurance will always be the least expensive.
Okay.
For example, our average 35-year-old female, non-tobacco, healthy individual, you can get $1 million of coverage for less than $30 a month. Very affordable. The reason why it's very affordable is because the reality is the insurance company, they don't ever anticipate paying that $1 million death benefit to your family. And the reason why they are so confident about that is because they have actuarial science on their side. They pretty much know how many 36-year-old females are going to die in 2021. And most likely, it's not going to be a lot of them. Most likely, that 30, 40-year-old female is going to live probably until she's in her 80s, 70s, 80s, maybe even 90s, which is why they structure the term insurance to terminate before you reach mortality, before they expect you to die. So term insurance is less expensive than any other type of insurance contract out there.
Okay. All right. Can you talk about when you taught me something that I didn't know anything about, how you can leverage your life insurance policy? It's non-term, correct?
Yep, it's the permanent.
Permanent, I'm sorry.
Life insurance.
Permanent insurance, and how you can leverage that in a business loan or something
Right.
like a house. You want to talk about that?
Sure. So I have some clients that have implemented permanent life insurance years ago. So they're probably in their 10th plus year of the contract. And because we've had some time to grow that equity, now they have this asset on their balance sheet. And that asset is growing at a rate. Most likely, it's probably growing at the interest rate that the insurance company is getting on their portfolio. Well, that asset, if I'm going to the table, if I'm trying to buy a property in this example, and they want me to come to the table with money, well, one could leverage their accumulated value in their permanent life insurance to the bank or to the lending company and say, hey, look, I know you want me to come to the table with X amount of dollars. I'm fine with that. But I also like to leverage this equity that is in this asset, this permanent life insurance, this tool. And by doing so, essentially, you are using that asset as collateral for the purchase of that said asset, that other asset. Maybe it's a house or something else. So one could say, instead of coming to the table with cash, maybe I'm coming to the table and saying, all right, look, here's my 20%, but I'm using the equity in my policy or using it as collateral to close the deal, to seal the deal.
Yeah, right. I hope that ain't go over people's heads. I hope y'all just learned something new. That's a lot. That is like that's some hot item right there. I hope y'all pay attention to what she just said right there.
Well, let me also share this, Jared. Maybe I can give a different example. Let's go back to the house example. We have equity in your house, right? And let's say that house is paid for. Well, that is an asset that the bank will be all over. I don't have to come to the table with cash, because if I'm willing to collateralize the equity in this house, well, I can come to the table with that, with the equity that's in that house, as opposed to coming to the table with my hard-earned green cash. Maybe I can keep my cash, or keep some of my cash, and I can close the deal with the accumulated value in the contract.
Exactly. That's some good knowledge right there. I got another question from Byron Francis again. Do you encounter a lot of people that outlive their insurance, and how do you handle that situation?
Good question. So I do encounter those that outlive their insurance. Most of the time, these are individuals in their 50s, 60s, and 70s, where they implemented a life insurance contract 20, 30, 40 years ago, and they didn't die, so they're still alive. Now, their need for coverage is still present. However, the reasons that they need coverage is very different than what they were 30 years ago. For example, your average family in their 30s, they have kids, they have a mortgage, they're doing their thing, they're working, they're paying down debt, they're saving, etc. Most likely that family, that couple, will probably have a greater need of death benefit because they're still in the accumulation phase. Fast forward 30 years from now, when the mortgage is paid, when the kids are financially independent, when there's no more debt, when they have $2 million of assets in their investments and retirement accounts, their need for life insurance typically goes down. However, what I experienced, the need never really goes to zero. It definitely decreases substantially because of those because life just changed for them, right? However, the need doesn't necessarily go to zero. And because it doesn't go to zero, many of those 50, 60, 70-year-olds that had $2, $3, $4 million of life insurance when they were in their 30s and 40s, now that they're in their 60s and 70s, they're saying, hey, Anitra, I don't need the $3 million of death benefit anymore, but I need something to take care of my surviving spouse and other family members, if that's important to you, in the event of my demise. For example, here's a great example. Met with a couple earlier this week. They're 70. They've outlived their coverage. They don't have any debt. Their children are grown. In fact, they have grown grandchildren at this point, and they don't have any debt. So their need for coverage is not what it was 30 years ago. However, if one of those spouses died prematurely, the surviving spouse would have an income deficit, because the pension that's coming in for that 70-year-old today and that Social Security benefit that's coming in for that 70-year-old today, the moment that he or she passes away and leave their surviving spouse, those benefits either go down to zero or they're cut in half. And so the surviving spouse, they still need to live. And so oftentimes the need for coverage for that 70-year-old is not to take care of the things that were important to them 30 years ago, but now it's important to just maintain the survivor's lifestyle until he or she passes away.
Okay. That was a good information. I didn't know that. I didn't know if you reach a certain age and your spouse passes and you're on Social Security and retirement, they'll cut those benefits in half or go to zero. I never knew that.
Yeah. So let's say if you had a pension, like a lot of people don't have pensions anymore, but the very few that are lucky to have one, most pensions, they're paid for that person or to that person for that person's life. But if that person dies one day after retirement or 20 years after retirement, oftentimes that pension is impacted if there is not a survivor benefit on the pension.
Okay.
Same thing with Social Security. So when you and your spouse reach Social Security, and whenever you pass away, well, yes, your spouse will be eligible to receive your benefit, but it's going to be a reduced amount because you're no longer.
All right. Mr. Francis has another question. I keep giving it to him because he's asking some very good questions. Should we get coverage for our kids? What age should we start, and how much should we start with?
Those are very specific questions, but
Right.
but should we get coverage for our kids? I mean, we watch the news. We see that death certainly has no age on it. I would definitely recommend that you implement some sort of coverage just to take care of any final expenses of that horrible event ever occurring to you or a family member. Again, with life insurance, premiums are based off age. So the sooner you start, the younger you are, the less expensive the life insurance premiums will be, whether that's term insurance or permanent life insurance. So getting coverage on your child at a very young age, even as early as 2 weeks old, is not a far-fetched thought. In fact, I would encourage it. I know personally, I've implemented permanent life insurance for my children so that when they are my age with their own families, if their health failed them between now and then, or if they've made some life decisions that are not in their favor, they can still do proper planning for my grandchildren, because some of those benefits, you can design them to where when they reach a certain age, you can increase the coverage without without the child having to go through any additional underwriting,
Okay.
medical
All right.
underwriting. So,
All right. What? All right. Thank you, Mr. Francis, for your questions. I have another person, Miss
okay.
Allison Yates. So for generational wealth, if that 7-year-old family wanted to take out another policy to be passed down to their kids when they pass, wouldn't that be an option as well, or to even help the surviving spouse with expenses?
Okay, I got it. So, Allison, yes, it would be an option for that 70-year-old in that example to get coverage if their health is still as good as it was 30 years ago, and if their current cash flow can support the premium. Because remember, getting that same death benefit on a 70-year-old versus a 36-year-old is going to be a drastic premium difference in cost. And so, unfortunately, if that occurs and there's not enough cash flow to support the need of the coverage to replace the term insurance that did terminate, that they outlived, sometimes they have to go without. And then now we have another family that is going to be asking for financial help from others because they don't have any life insurance in place when they die, whether that's at 70 or 97.
Okay. All right. Uh, that's some good questions right there.
Mhm.
So let me ask some. Can I ask some a question, folks?
Of course
You
you
know what I'm saying?
can.
'Cause people from comments is asking away. All right. So since you've been a financial advisor for a few years, oh, actually, what, almost 2 decades, right?
14 years. Yep.
14 years. What are the do's and don'ts if somebody wanted to get in your field? What do you recommend they should do and not do?
So, as far as education, I think a lot of people are under the misconception that you actually have to have a degree in finance or accounting or economics, and you really don't. It certainly helped. My finance degree does help me, but it certainly is not a requirement. Um, I, I know the industry, certain companies, they look for individuals that have at least a 4-year degree, and in any degree for that matter. In fact, one of my closest colleagues was an attorney for several years prior to her becoming a financial advisor 20 years ago. I have another colleague who was a dentist for several years until he was unable to practice dentistry anymore, and then he got into this industry. So any any background is open as it relates to education, because the company that you affiliate yourself with, that you're going to get that training, they're going to provide you with the training, the skill set, etc., that you need to excel. Furthermore, I would encourage you to further your education within the discipline of financial services. That's something that I chose to do earlier on in my career, so that I can not only have the knowledge, but the confidence to communicate with my clients about what their options are. So, education, I would definitely recommend that. Getting into the industry, I would encourage you to do as much research as you possibly can about the different companies that are out there. There are certain limitations that are out there. I also believe it's important to be affiliated with a company where you're not captive, meaning as a fiduciary advisor, I don't feel compelled to push one company over the other, because I'm not captive with any company. Captive meaning I'm working with XYZ company and I can only offer their products and services. So that's something that, I think would hinder your success in the industry, in my opinion, as opposed to working in a capacity where, hey, I am affiliated with XYZ company. I have access to their products and services, but I'm not captive to them. In fact, I'm licensed with 20 plus other companies in the industry. And that really allows me to position myself as a fiduciary advisor to my clients. So education and research, to answer your question, educational background, and then doing research on, what, which company, which platform are you going to use?
Okay. Does it require any type of certification or test that you need to pass?
Yes. So the financial planning, so a lot of the planning that I do involves not only investments, but insurance products and services. So here in the state of Louisiana, and any state that I practice in, I have to be a licensed advisor to sell life and health products. But then I also have to obtain a securities license in order to be able to recommend and implement and service any investment securities.
All right. And how much do those tests cost? Is it very expensive?
That's a very good question. And to be totally transparent, I really don't know, because the company that I'm affiliated with, which is Northwestern Mutual, when I did the internship with them back in 2007, they paid for all of my licensing. So I really don't know. And in addition to that, they also covered all of my, when I furthered my education with the American College of Financial Services. So not only did I have my finance degree and got the state licenses, but I furthered that education in certain disciplines within the industry, whether that's dealing with retirement income distribution strategies or insurance products or just retirement planning as a whole.
Okay. And do those, once you attain those certifications, do you have to keep taking more tests, or you just have to continue doing continuing education units or training?
Mm-hmm. That's a good question. Like I tell my son, who doesn't like to take tests, I tell him all the time that it's never going to end, son. It's never going to end. So the education definitely continues. So yes, we do have to keep up with continuing education credits throughout the year. So like I think here in Louisiana, it's every other year where we have to report a certain number of continuing education credits that we've earned to make sure that we are staying updated on the many changes that occur, within our industry. So yes, constant learning.
Okay.
That's what all these books are back here, by the
way. Okay. All right. So since we're in the middle of a pandemic, can you explain how COVID impacted your business and your clients, and how I know you're probably getting phone calls after Wazoo, probably in around April and May of last year. So how did you handle that?
Yeah. So the pandemic definitely, I think it forced Americans to really think about the foundation that I talked about, which is having that emergency fund, because what if I'm unemployed for a period of time? How am I going to sustain my life? And how am I going to sustain the financial plan that I've implemented? Because the reality is, all of those that suffered last year and even suffering still today that are unemployed, their financial goals didn't change. I can guarantee you they still want to retire. They still want to save for their kids' education. They still want to take their families on vacation. They still want to renovate the bathroom, renovate the kitchen, or do any other or meet any other personal savings goals. But if they did not have that foundation in place, that 6-month emergency fund, or making sure that they have something that they can fall back on, I think that's what caused a lot of individuals to panic. As it relates to what impact did the pandemic have on my practice, I think it forced a lot of individuals to take a look at their balance sheet and take a look at the plan. The clients that were calling me, in the middle of all of this last year, many of them were at peace knowing that we've already taken into consideration these unforeseen events. This is why we did the planning, so that when life does come at us fast, whether it's a pandemic or whether I'm unemployed or whether the roof has a leak or whether the car needs to be serviced or whether we're trying to figure out how we're going to cover summer camp costs in a few weeks, you have a plan in place for that. And I think if nothing was brought to light throughout this past year, I think it's in that area where it's forcing people to really either pursue conversations so that we can minimize this taboo spirit that we have in our community about talking about money and investing and saving and planning for the future, but also helping them understand the importance of having a plan in place.
All right. So I got a few more questions. I
Sure.
always ask my guests this. So what was your biggest mistake in your career and how did you bounce back from that?
Biggest mistake in my career was not pursuing individuals that I assumed were financially set.
Okay.
Meaning, we all look at people around us, right? Whether it's our neighbors, our coworkers, or just people that we know around, and we all make assumptions based off of where they live, what type of car they drive, what industry they may work in, occupation, etc. We make these assumptions, and one of the biggest mistakes that I made was assuming that this individual had a financial plan, was already working with an advisor, et cetera, et cetera. They were financially set. But the reality is, when I did finally reach out to them, they were like, Anitra, I'm so glad you reached out because this has been on my to-do list for years. And so that was a big lesson learned, that now I don't make any assumptions. I reach out. I continue to reach out. And when the timing is right, we'll have an opportunity to connect.
All right. All right. So what was that moment when you knew that I can do this? I can be a financial advisor for anyone. What was that moment? When did that hit you?
I would probably say, maybe 5 years into, growing my practice. This is definitely a tough industry. It's not meant for everyone. The rate that people get into the industry and get out is extremely high, especially high for a Black woman. And so it wasn't until I got my bearings with my practice, maybe fourth, fifth year into the business, where I was like, okay, I know what I'm doing. I have the knowledge. I have the skill set. Now I just have to trust myself and know that I'm doing the right thing. But then also, I rely on a lot of other colleagues as well. So if there's always an opportunity for me to consult with another advisor about a case that I'm working on. No different than our doctors may consult with other specialists about our health, or no different than other attorneys working with other attorneys that specialize in other areas within law, depending upon, the case or the complexity of the case that they're working on. So I think a combination of all of that is what helped me come to the realization that, okay, Nitra, I can do this and I can really have an impact on the lives of the people that I'm connecting with.
Okay. She brought up race. I always ask my question. Always ask this question. In the middle career, have you ever dealt with any racism, sexism, people not respecting you just because of the color of your skin, or you just being a female?
Yeah, that's an interesting question because I can't recall a situation in the last 14 years where I've dealt with like direct racism.
Mm-hmm.
I think we are often exposed to a lot of microaggressions.
Right.
And also, I think one of the biggest things was I had to get over in my mind that despite the color of your skin, I'm capable of helping you. Now, whether or not you want to believe that based off of the color of my skin, then that's something that, that's on you. That's not on me. But that was honestly the number one reason that drove me to further my education, to get those designations so that not only I can have the skill set and the knowledge, but have the confidence. Because now I know that no matter who I'm sitting across the table with, whether they look like you or I or not, that I'm capable of impacting their lives and the lives of the people that they love the most as well.
All right. All right. We have one more question from Mr. Byron Francis. Would you advise wealthy couples to purchase coverage?
I'm assuming that he's referring to coverage as it relates to insurance coverage. And to answer that question, I would say yes, depending upon what their financial situation looks like. So my assumption is not that every person that I meet with, I'm assuming that they need X, Y, and Z. We take them through a process so that we can identify what those needs are, and then we design a plan around that. So whether they're wealthy or your average American, I think what's the differentiator is the process that we take our clients through, so that not only are we having a logical discussion about what needs to be done, but we're having an emotional connection to that as well. So tying what you want to happen to what your heart is telling you so that we can design a plan around that.
All right. All right. I have two more questions and I'll let you go.
Okay.
I always hear this. We see them in commercials. We see them in brokers' accounts. What is the difference between an IRA and a Roth investment account?
Sure. So
short version, because I know.
Short version. The shortest version is when you're ready to start spending your money, do you want to pay taxes or do you not want to pay taxes? So a traditional IRA, you use pre-tax dollars that Uncle Sam have not been paid on yet. Thus, when you pull the money out at distribution, those dollars are going to be taxable to you at ordinary income tax rates. Versus a Roth IRA, you're using after-tax dollars that Uncle Sam already got his cut on. Thus, when you pull that money out in the distribution phase, it's received as income tax-free. That's the short version. So traditional IRA, you're using pre-tax dollars to fund that account. Thus, when the money comes out, it's taxable. Versus a Roth IRA, you are using after-tax dollars to fund that IRA. Thus, when money comes out, it's 100% tax-free.
Okay. All right. And I guess you recommend it. I guess depends on what the client need at that moment in time.
Absolutely. And not only what the client needs are, but what their income needs are, or what their current income is, because not everyone can participate directly into a Roth IRA. Okay. For those clients that I'm working with that are above the IRS income limit, typically for married filing jointly, if you're over $200,000 of adjusted gross income, you can't contribute directly to a Roth IRA. There are ways that we can get dollars into it via a backdoor Roth strategy, but those are the two options, traditional or Roth, and that's the difference between the two.
Okay. All right. What type of technology do you utilize to help you with your business? Because I know I'm not gonna answer it, but I know. Go ahead and answer.
A lot. So we obviously this business, we deal with a lot of confidential information, a lot. So I minimize paper trail for that reason, and I make sure that we have extreme security in the technology that we're using. Thus, all of the notes that I do when I'm in a meeting, all of that is on a software that's communicated directly to our office. I don't have to print out anything. I don't have to email anything. It's just shared directly there in real time. So we use technology for that when we are onboarding a new client. So once we get a new client to work with us, we use technology with implementing those accounts, whatever those accounts may be. So whatever accounts that we need to open to implement their financial plan, all of that is done electronically now. How I interact with my clients, even prior to COVID, I would probably say I was doing maybe 60% 60% virtual, and 40% of the meetings were in my office. Obviously, this past year, that's changed to almost 100%. But, I had to quickly leverage technology earlier on in my career as my clients moved about the country, because obviously they physically couldn't get to me. So we've been, using technology for sure in that magnitude, just as you and I are doing today.
All right. Thank you. Thank you for coming on the show. Can you please let the people know where they can reach you on social media outlets and websites and all that good stuff?
Absolutely. So my website is anitrablue.nm.com, where you can find more information about myself, my team, my practice, and schedule an initial consultation with me. I can be found on LinkedIn and Facebook under Anitra Blue Francis. And on Instagram, I can be found at Your Financial Advisor. That is YOUR Your Financial Advisor.
All right. Thank you for coming on the show. Somebody did leave a message saying, Anitra, I sent you a message on Instagram. It's going to say a different name. I do have some financial questions.
Okay, awesome. I'm looking forward to connecting with you.
All right. See,
thank you, Jared, for having me.
Thank you. Remember, everyone, please share, like, and follow, and share this video to everyone who thinks needs to hear this. Thank you for listening. You have a good night. See you next time. Enjoy. Any last words, Anitra?
Don't be afraid to connect with a financial advisor. That's the first step. Take that initial step, because it's certainly a differentiator in your financial plan.
Okay. So I gotta post this.
Yes. I see the question. Are you going to read it? You want me to read it?
Are you married?
I am married. I've been married for 10 years to Byron Francis Jr.
Shout out Byron.
The beard man, Byron the beard man. I've been married to him. We have two children, two beautiful kids.
Look, I didn't realize it until he kept asking questions. I was like, "Oh, this got to be us. This got to be us." All right. Thank y'all for watching. Thanks for coming on the show. See y'all next week. Peace.
Thanks, Jared.